I'm curious, maybe just to begin, give us your high-level take on the Federal Reserve, the FOMC minutes from yesterday, a couple of your competitors, such as Barclays, interpreting those minutes as more of a hawkish tilt for U.S. monetary policy.
Well, I think they're really kind of more of the same. There wasn't really a lot of tremendously new information, but as was mentioned earlier, it's very clear that the majority think that at least 3 hikes for next year. So the Fed seems to be on autopilot. They're hiking fairly consistently, albeit gradually. They're surprising markets toward hiking closer to the dots than not. Markets are better priced for that now than they were at the beginning of last year, which is part of the reason why the markets didn't really, the bond markets in particular, didn't really react to the minutes. But we think the Fed will continue grinding rates higher through the course of 2018.
Yeah, Ray, I want to press you on that market pricing because we have seen a bit of a tick up in U.S. break-even rates. So if you look at the chart next to me, it's G#BTB 3418. That shows some break-even rates across a couple of tenors. I think it's 10-year and 30-year. They're ticking up above 2% for the first time since March. And we have seen some economic data from around the world showing a little bit of an uptick in inflation. So, for instance, we had some of the PMIs coming out this week suggesting that maybe price increases will be gaining over the next year or so. What's your take on the market's positioning for inflation? Is that the wild card for 2018?
Certainly, any really big upward surprise in inflation would be a shock to markets. But I don't think that the big, the rise that we've seen so far in break-evens is altogether that large or surprising. It makes sense with the growth data, the new tax plan in the U.S., all of that to imagine that the continuing strength of the U.S. economy would add some degree of inflationary pressure. We've got inflation forecast to rise between now and the end of this year, but with core PCE still sub 2%. I think the other factor here is that oil prices have gone up a lot, and those break-evens are about headline CPI, not core PCE. So they have to incorporate some degree of the fact that oil, as a sort of cost shock to the system, has gone up and really doesn't have any signs of coming down anytime soon.
Yeah, Ray, with your fixed income hat on, walk us through the action that we saw in the bond market yesterday. Kind of muted, I thought.
As I said earlier, I don't think the Fed really gave us anything that was particularly surprising. They're grinding their way toward what is now pretty well priced in the markets. So there wasn't a whole lot for markets to react to.